Okay, so we move into Chapter 21, IHT Inheritance Tax, Part 1. So our first exposure to this slightly unusual tax, but certainly from my perspective, quite an interesting one. I'll explain why as we move through. So let's take a look at this sort of the basics, as it were. This introduction in Section 1. Note that we have several parts to this particular section of the course as with previous. So in terms of the concept and indeed the scope, let's note that IHT is really a tax on transferring wealth. In other words, gifting things or giving things, whether or not that's in lifetime when the person is alive or indeed on death. So what are the implications of gifting or giving things? Well, key point to note, and this may be new or new news to many people, that IHT, inheritance tax, can be due, or in other words, tax can be due in lifetime. So it's not necessarily a case of the individual dying and being subject to this tax. And note that that tax is effectively due around about the time of the gift. Okay? Outside of that, in terms of lifetime gifts, where let's say that IHT isn't due, there's several different types. But let's say, for example, as we'll see below, with a PET, with a PET, a potential exempt transfer, it will only be due if the donor, in other words, the giver or the gifter, dies within 7 years. So really, two instances outside of the death of the person. In terms of this next area, we sort of sum up. So really, we're talking about transfers made in lifetime, that are divided into three categories. Firstly, as we said up top here, some are chargeable. They're called chargeable lifetime transfers. Some are PETs or potentially exempt transfers, and some, note, are completely exempt. More of that later. Okay? Now, just note that in relation to the CLT, the chargeable lifetime transfer, i.e. the transfer where tax may be due when the person is alive, generally speaking, that's a transfer into a trust. What is a trust? Think of a trust as really a pot, as it were. You literally have property. I have a house, I have cash, I have shares. I'm going to put these items, one or other, or all of them, into a pot, let's say for the benefit of someone else, perhaps my daughters. So in effect, a trust is an arrangement and under which legal title, in other words, ownership and indeed control of the property, is transferred from the creator or the donor, the giver, the gifter of the trust, to the persons appointed to manage the property, i.e. the trustee. So these are people that the individual donor or giver appoints, and obviously he trusts them to manage the property for the benefit of others, i.e. the beneficiaries. For example, my daughters, but it could be anyone. It doesn't have to be relatives. So there's our sort of intro, if you will, in terms of the concept and really the scope. Now, several things that we've learned: that IHT can be due in lifetime and indeed on death, that there's different forms of lifetime transfer. We've got to be clear on the implications of each of them. And indeed, we've introduced the idea of a trust. Now, in terms of the transfer of value, in other words, how much are you transferring? A key concept which is unique to IHT is this idea of diminution in value. So in other words, it's effectively the measure of transfer value. So you'll be thinking to yourself, well, okay, well, you have a house, you gift it to someone, that's the value. Well, yes, but different types of assets work in different ways. For example, think about shares. Let's say where the individual has a controlling interest, 90%, 80%, 75%. And let's say the individual gives away 40%. Well, that 40% would be valued differently to the remaining balance because there's control. So that's the idea. Diminution in value, and it's normally examined in terms of shares, is really the idea that the amount by which the transferor's estate is reduced by the gift, and that may well not be just the market value. Okay? So watch for that, more of that later. Now, in terms of property, we use the word property in IHT in many different senses. Property is really anything. Yeah, property could be cash, property could be shares. It doesn't have to be a property. So note that property for IHT is all property unless it's excluded property, and for that I mean basically exempted. So also note that in terms of a comparison to CGT, they're often compared, these two taxes. There's no issue of a chargeable asset. Assets, are either sort of exempt or not, or excluded property or not, but certainly assets treated as exempt for CGT purposes remain liable to IHT. So don't get confused by that, okay? Outside of that, in terms of the transfer itself, we talked up top about diminution in value. Well, this little pro forma sort of helps us out, because really what we're looking to do is to establish, well, okay, I get the idea of you transferring wealth or transferring value. What can I do to reduce it? Well, you can take off any exemptions that are relevant. More of that on the left-hand side of this mind map. And then you get to the chargeable transfer, the actual value that's in play for IHT purposes. Okay? So more of that later when we look at the pro formas. So in terms of the occasions of charge, outside of the intro section, here we've got to talk about this idea of the areas where IHT becomes due. And really, this whole area is sort of centered on 3 stages. Okay? You'll see up top, lifetime IHT, as I mentioned. Okay? So where an individual makes a CLT, a chargeable lifetime transfer, i.e. a gift into a trust, the stage 1 computation comes into play. Now, don't be worried about that if you haven't studied the study hub too carefully. All I'm talking about is a pro forma that relates to the calculation of tax at this point. Okay? That's number 1. In terms of number 2, additional IHT on lifetime transfers arising on death. Now, here's the rub here. What we're talking about is, okay, an individual plans their IHT affairs and decides to make some gifts in lifetime because, the earlier that you gift, the less likely that amount is to be included in your estate. But let's just say the individual, from the point of gifting, 7 years doesn't survive. So only survives for a couple of years. In that case, additional IHT will be due on the gift up here. So as the whole idea of gifting within inheritance tax is so important, and the key phrase is gift early. In other words, gift early in your lifetime. If I have 50 houses, millions of pounds worth of cash, shares, etc., etc., if I want to ensure that, let's say, my children and or grandchildren don't become subject to tax on my deathbed or when I die, I should gift early. I should give away things, let's say, to my grandchildren or indeed my children early in life so that I survive 7 years. Because if I don't, the stage 2 computation comes into play. This is a double whammy. These are, in effect, one in lifetime and one effectively as I die. Okay? So that's stage 2. Stage 3 is what we would expect. In other words, stage 3 is where tax is due on an individual's death estate. Okay? So when an individual dies, any remaining property held at death falls into charge. So in other words, let's just say that I were to die, God forbid, the HMRC in the UK would simply list my assets. What do you own? What did he own? Yeah? Houses, properties, cars, etc., etc., etc. They would list everything, and broadly speaking, the stage 3 computation is about taxing what I own on my death. So you can see in relation to this stage 3 calculation that if I've been savvy, if I've been cute, if I've been sensible in these areas, and really gifted early and hopefully survive 7 years in relation to these gifts that I've made, then I could be in a position where my death estate is minimal. Okay, I own very, very few things, and on that basis, my IHT would be mitigated or reduced. Okay. Now, in terms of lifetime transfers, we sort of touched on this already. In effect, we know we've got 3 main areas. Exempt, which I'll talk about in a moment. PETs, as I've mentioned, yeah, gifts to individuals. They become chargeable, yeah, if the donor dies within 7 years. Chargeable lifetime transfers, remember, taxed immediately in lifetime. And again, remember we talked about additional tax. Yes, additional tax if you die within 7 years. Okay, so that's just a sort of a reiteration of what we touched on up top. So we've mentioned now exemptions several times. We like exemptions because exemptions reduce transfer values. So in terms of, exemptions relevant to lifetime transfers, transfers in lifetime, and the death estate, basically there's only one. Yeah, there's the transfer between spouses or civil partners. Okay, now they are entirely exempt from IHT. The implications are really that if you think about it, if you have a husband and wife or civil partners, the first spouse to die can leave the whole of their estate, yeah, free of IHT to the surviving spouse, yeah. Outside of that, one spouse can transfer a property in their lifetime to other spouse without the process of incurring IHT or CGT. So this interspouse exemption, which is what it's called, is very, very handy, yeah. Now, when I say it's handy, it's great IHT planning, because if I die today and I leave everything to my wife, if I had a wife, yeah, then she would not pay, and I would not pay any IHT, but we're only storing it up for the future because she will have to die sometime, yeah? So it's planning, I guess, in the short term, okay? Makes sense in the short term, but in the long term, those assets, which may increase in value, property, shares, etc., will be caught by the IHT net. And that is why it's used, but not necessarily entirely on its own, okay? So that's a transfer only in lifetime and on death. That's the only one. What about only in lifetime? Well, 4 main ones. Now let's remember, let's not use these at death. These are only available to the individual in their lifetime. First one, gifts out of income. If we have an individual, let's say they're going about their business and they decide to regularly give, let's say every Christmas, £20,000 out of their income, not their capital. Remember that IHT is a wealth tax. Yeah. So the conditions of this exemption, in effect, out of income, are that it's regular giving, let's say every Christmas or every birthday, and indeed that the transferor's standard of living is not reduced by the gift. So what you can't do willy-nilly is simply start giving away items, cash, property, etc., and lose your standard of living, because the revenue will say, well, actually, you're biting in to your capital, and we want you to keep your capital for IHT, for inheritance tax, so we can get our sticky little fingers on it. So this particular exemption, although useful, you need to be careful that it is part of a regular pattern and doesn't affect after tax standard of living. That's the first one. The second one, small gifts. Now, this is extremely common in the exam. It's coming up in your exam. I'll go as far as to say that. We're talking about a small gift of less than 250 to any individual. Note, it can't be 300. In other words, it's up to 250. That's it. If you go above that amount, it's not exempt. Okay. So, and these are to each individual. You can't give 5 different gifts to one individual all below 250. No, it's one. Okay. Outside of that, next one, gifts out of income. That should actually read marriage exemption. My apologies. I should adjust that. So this should read gifts in consideration of marriage. In other words, this is what should it say here. Okay. Now, what's the deal here? Well, the relationship. So if we have, let's say, a parent giving to a child, to a son, let's say, 5,000 of the gift value is exempt. If it's a remoter ancestor, i.e. grandparent, for example, or other party of the marriage, 2,500, or indeed anyone else, 1,000. So notice the way it's sort of tiered, yeah, or sort of slides downwards in terms of the individual's relationship with the person, okay? And so you could have a gift, let's say, by a parent to a son in relation to his marriage, 50,000, 5,000 of it as a minimum is exempt under this banner, okay? Last one for us, probably the most important one, the one that will always get examined bar none, is the annual exemption. The first 3,000 of any lifetime transfer is available. Okay. Now note that we can, if we haven't used it, carry forward 3,000 from the previous year. So let's just say last year, this value of 3,000 wasn't used. I didn't make any transfers last year. Then this year, I can make two lots of three, 6,000. Okay. Remember that the current year transfer is always used first. Okay. Then the brought forward one. Okay, so I could run out of gifts in effect, and it can only be carried forward from 1 year for 1 year from last year. So I couldn't, if I don't use it in this current year after carrying it forward, I couldn't use it next year. It's gone 1 year only. Okay, so these exemptions are absolutely key to your success in IHT questions. They're going to be examined. Now, we talked about IHT payable in lifetime in terms of this area of lifetime transfers. And I mentioned to you a pro forma. Well, there it is. Yeah, I said there's a stage one calculation. Okay, there's a stage one calculation, and this is the top part of it. I'll come to the second part of it in a moment. So in effect, you see here, we have this value of the gift. Let's not think too much about the diminution in value for the moment. Let's just say, you know, there's a gift. Okay, let's take off any exemptions, yeah, that are relevant as just discussed. Let's get to the chargeable amount. Now, when we move down the page here, my apologies, we move down the page here. Let me just find where I was again. What we'll see is here's where the tax comes into play. Okay, now in terms